Welcome to my Protect Your Wealth from War fireside. This is Natalie Pace, and we have a lot of resources for you. Today is March 26th, 2026. And as of today, the S&P 500 is down 7.5% from its most recent high on January 28th. So we are receiving a lot of panicked emails because there is a war going on in Iran about how people can protect their wealth. They've watched them lose money, and there's a lot that you can do, and you have to do because you are the boss of your money. And in fact, if you lost more than 7.5%, that is a red flag that you need to get a second opinion on your plan, or you need to learn the life math that we all should have received in high school. So we'll get started in just a moment. Remember, you and your friends can watch this back, youtube.com/Natalie Pace. Subscribe there so you don't ever miss our video conferences and firesides. And you can also listen back on Substack, Natalie Pace. So as I said, the S&P is down 7.5%. Now, the reason I said that if your portfolio is down that much or more, it's an indicator that you need a second opinion, because when we keep the proper amount safe, so all of us should be age appropriate. We should have a percentage equal to our age safe. That it means it's not going to lose money, okay? And then we want to diversify the at-risk side. So the amount that you have safe, if you're 50, half of it's safe, right? So you didn't lose 7.5%. You might have lost 7.5% on half of your portfolio. Now, if you're at the age of 50, we're actually overweighting 20% safe in our sample pie charts. And the reason for that is that their stocks are expensive and there's a lot of wars in the world. This was even before the attack on Iran. So it's, there's a lot of things going on. Inflation, all of these things, slow down in the economy, frozen real estate market. So as we were seeing so many economic storms on the horizon, we were overweighting safe. Now, if you're 50 and you're overweighting 20% safe, you have 70% of your wealth that is not going to lose money. You got to do it right because you don't want even paper losses. We'll talk about that as well. But that means 30% is at risk, right? That goes down 7.5%. So you have not lost 7.5% in your whole portfolio. You've lost closer to maybe 2 or 3% because it's such a small piece of the overall large picture. Okay, so we did say the S&P 500 is down 7.5%, and I said that three of our funds are still positive on the year. So let's take a look at this. And this is from my most recent blog, which is a blog of hot countries. All right, so in the performance so far this year, Peru is still up, clean energy is still up, and Australia is still up on the year, whereas all these other things are down. So even on the year, if you were doing what we're doing in our portfolio, which is value replacement, so it's not all banked on the United States, and hot industries like silver, like copper, that sort of thing, then your performance is still so high. And the only real question is, did you capture gains? That's another piece of the pie, because I would say once a year minimum, 3 times a year would be a maximum. You want to rebalance. What does that mean? If all you've made a boatload of money, which stocks were at an all-time high January 28th, we held a rebalancing masterclass January 10th, this close to the all-time high, saying rebalance, rebalance, rebalance. What does that mean? If you have slices that have made a boatload of money, you keep that money instead of just watching it go down and then calling our office and saying, I'm losing money. You keep the money, right? So rebalancing simply means always be age appropriate, properly diversified, which it means that in bull markets, you're going to be capturing the gains and letting your wealth grow. And in bear markets, you're going to be protecting your wealth. It's already grown. So instead of it just going on the Wall Street roller coaster, losing a lot and gaining a lot, you are going to always have a plan that can earn gains. Now, I want to say we have proof of this because in the Great Recession, we had a plumber and his office administrator wife use the pie chart system we're talking about And instead of losing more than half of their wealth, which was what the Dow Jones Industrial Average dropped 55%, they earned money because the safe side can earn money. Okay, so let's take a look at a few more of the forensics and then I'll talk a little bit more. So when we come back here, we can also see that the 1 year performance on a great deal of our picks have been super performers too, right? SLV, that's silver. EPU, that's Peru, a copper play. Again, clean energy. So I did sort it here so that you could see all of the funds that actually outperformed the S&P 500, with the exception of very few. And when you come over here to the 3 year performance, Tech B and IWY, which are the growth funds, they so far outperform the S&P 500, right? So that is why you want to have not just, the Dow, which tends to be a value fund. You want to have a growth fund that also is going to include the Magnificent Seven. Now, they haven't done as well this year because they were too expensive, not because they're not great companies. So it's really important that you don't get lost in the weeds and chase things and freak out. They call it stick to your knitting on Wall Street. If you have an age appropriate, properly diversified plan in place that you rebalanced at our rebalancing masterclass on January 10th, you're sitting pretty. And if you didn't have one of the hot slices that we mentioned, and you were dollar cost averaging in, you're still sitting pretty because we said, hey, don't buy at an all-time high. Go ahead and take 2 years to fill up that slice. And that way, if stocks go down, instead of saying I lost money, you're saying, great, that's why I have this dollar cost averaging program. I can now buy more at a lower price. So very important for us to be doing. So again, over the 1 year period, we have, performers that were performing better than the S&P 500. Over 2026, 1 year and 3 year. And that what that means is that no, you should not just have an S&P 500. And by the way, if that's all you've selected in your retirement account, you don't have enough safe. So you do need to know at least a couple more things that you should be doing. Those of you that follow my work know that I think you should have your money in a retirement account up to the employer match because there aren't a lot of options there, although there's more than just one, and that you should be maxing out your personal Roth IRA if you can. And that way, that's where you have the freedom of choice. That's you can't buy a silver fund or a Peru fund in most employer-sponsored accounts unless you're self-directing. So it is important for you to understand the bigger picture. Also, if you love crypto, right? Like, what is crypto going to do in a war? Well, the last time that stocks went down, crypto went down. Also, we have another historical trend that plays sadly against performance of crypto, and that is the halving event, history that plays against it. A lot of people think, well, we have a crypto-friendly White House, and so they're betting on that. But, you want to look at the complete picture, not just one hot tip of information. So again, I do still, and I did put, through a rigorous test to see if we should be picking different countries. And these are the ones that are showing up again this year: Indonesia, Australia, Peru, and Ireland. And you can see why. These are all the things that I cover in this blog. Now, I also talked about oil prices, and the reason that it's important for you to also look at this blog, and again, I'm going to always put the links to the blogs in the YouTube channel description page so that you can easily cut and paste it or whatever you need to do to access it. So the reason I am including this one is that the price of gas and oil is highly correlated. When they spike, it's highly correlated with recessions. And the reason is that 70% of the US economy is consumer spending. So when consumers can't spend and they have to tighten their belt and all the money just goes to the oil company, we tend to have recessions. And that was outlined pretty clearly in this blog, which I am encouraging all of you guys to check out. If the war ends soon, then oil prices will probably drop pretty dramatically. They could go down to $60 a barrel where they were, and things could stabilize. So that's what Wall Street and that's what a lot of people are hoping for. If the war is prolonged and we don't stabilize oil prices, this is very, very bad for the US economy because not only will it mean that we could enter a recession, we could also have the inflation side out of control. That's the same situation we had in the late 70s, and it was a horrible situation for a lot of people. The Fed fund rate went as high as 20% in 1980. So you think it's high right now at 3.5, 3.75, and yet it was 20% when we had stagflation at the end of the 70s. So this can be a really big problem. It puts a lot of pressure on the government officials to find a resolution to this problem quickly and stabilize gas and oil prices. So I would say that I really want you to focus on these things. Always have a percent equal to your age safe. Overweight if you think that there are economic storms on the horizon. We saw them before the invasion, the attack on Iran. Then you have to know what's safe because in a debt world, a lot of people were sold into even those private credit funds as safe, and they weren't. And when I saw it, I was alarmed. And also, you can have trouble getting your money out of them. So before you buy anything, you better know what the exit strategy is. You better have an understanding of how safe it is or not, not just what the broker salesman tells you, because they may be in a sales meeting where they're told they're supposed to sell this and that they are supposed to sell it as safe. And they'll have all of the legalese that supports that so that they can't get sued. So it's really important that you're the boss of your money and that you can kind of step aside if a salesman is hitting you too hard on something that doesn't add up. So so I talked about that. Keep a percent equal to your age safe, overweight safe, know what is safe, properly diversify. We are, again, not just betting on the US because there are many reasons for that. Australia has a higher credit rating than the US does, and they pay a higher interest rate. So you are actually earning more income to take on less risk. Indonesia is supposed to grow at 4.9% GDP this year. That is more than double what the US is projected to grow at. So at that rate, they could. And the reason that they haven't is that investors just haven't gotten enamored with the idea of investing in Indonesia. But if you wait for that moment to happen, you're going to be buying high instead of profiting from it. So I would encourage you to check out these blogs that I'm mentioning. Again, oil prices soar, stocks sink, and what's going to happen in various scenarios. And again, my new hot countries, which is the most recent one. Also, this one, 15 Rules of the Rich. So basically, what I'm doing is I'm showing you a lot of the things that I'm telling you in this. How much should you have in your 401k? Do you have a health savings account? If your health insurance doubled, and a lot of people did, is there a better solution for you, right, than waiting for politicians to solve the problem? You could actually right now be saving thousands in your health insurance and also saving money on your taxes. So there's lots of ways that you really want to be learning the 15 rules of the rich. They're legal, so why don't you follow them? This was something that was very popular for people who said they were conservative investors to get sold into. And also, by the way, when people tell you high yield, it's not really that high. It's like 1/4% higher than what the Fed fund rate is. You're not getting paid to take on risk. And by the way, when someone says high yield, it's usually also an indicator that it's lower credit quality. And our mantra for the safe side, because we don't want paper losses and we don't want losses of any kind, is keep the term short and the credit worthiness high. So again, if you're doing all of this, you're not freaked out about the war right now because you're properly protected, no paper losses, earning an income on the safe side, and your at-risk side, you still have things that completely went crazy over the last 3 years, right? And so you're a lot richer today than you were before. Another blog that I wanted you to look at, which I'll also have there, is that even before this is from before the attack on Iran. AI was already saying there's a 70% chance of a correction in 2026. And the reason that I posted that blog is because I had been telling people that pre-election year, I mean, the midterm year, that election cycle is not a good one. So we saw in 2022 that the S&P 500 lost 20%. We saw that the Magnificent Seven companies, some of them lost 67%. Cryptocurrency lost 67%. Bonds lost 26%. So if you were in the wrong kind of bond, again, not our portfolio, no paper losses in ours, but it was a severe enough problem that we lost 5 banks in March of 2023. So again, our strategy is both defensive and offensive. We're outperforming in the offense and we're well outperforming in the defense. And if you're using this, you don't want to think, oh, I lost money whenever the stocks go down, because no, that's not what happened. You had enough protected so that it doesn't matter which way the stock market goes, right? You have enough protected. You're in a better seat. Having liquidity when everybody else loses 7.5% or more of their portfolio, that's going to be very valuable, especially if the war is prolonged, which is going to be very negative for stocks. Okay. And if you're on your dollar cost averaging plan, then you're actually disciplined and prompted by the system itself to buy low instead of what other people are going to be tempted to do because they think they've lost so much money and it's never going to get better. They sell low. So this plan is a buy low, sell high plan on autopilot that actually prompts you to do the right thing. Now, I also wanted to just show you this because I told you this at the top of this meeting, is that right now interest rates are at 3.5 to 3.75. There's no projection that it's going to be a rate cut at the next meeting. And there's a small projection that we may actually have to get a rate hike. That's also going to be hard on the economy, right? Because people are having trouble buying houses because the mortgage rates are so much higher than they were in 2020. And today, combined with unaffordable housing and a higher, it's not high by historical standards, it's just high by most recent history, it makes it unaffordable. And so we have a frozen housing market as a result of that. So again, it's all, will the economy come back? Will stocks come back? All of these is really, will gas prices get lower? It's all predicated on what happens in Iran. If the war is over quickly, then you should see jubilation on Wall Street in the short term. Again, there's other challenges out there, which is why we're still going to be overweighting 20% safe. So in the short term, you'll see jubilation on Wall Street. But in addition to that, you still want to be diligent about what you're doing. And you might even be happy that you bought a little bit more low if you did your dollar cost averaging now when, some of these funds have already dropped a little bit. So I guess that's what I would say is it's always stick to your knitting, right? Keep a percent equal to your age safe, overweight safe if there's economic storms on the horizon, know what's safe in a debt world, properly diversify and rebalance once, twice, or 3 times a year. When you're rebalancing, you take it off of the brokerage statements because the brokerage statements are going to jack your emotions around and they don't include your checking money, your crypto money, and all of that. So you need a complete picture. And when you look at the complete picture of what you have compared to a sample pie chart, which you can use with our free web apps of what you should have, it's easy and there's no emotional connection there. It's like, oh, I actually might want to buy low in this one because it's smaller slice. Oh, I might want to capture gains in this one because it's too large. And then you keep that wealth. All right, I'm going to go ahead and let me see if there's one more thing I wanted to show you. There might be. Let me just make sure. Yes. So again, this is the other reason why we're overweighting safe is that by this standard, this is the Buffett indicator. Stocks are higher than they've ever been. The CAPE ratio, stocks are almost as high as they were in the dot-com recession. I'll tell you why that's important. Higher than they were in the Great Recession, Depression, 1929. You've heard about that. So let me show you what happened after the dot-com recession when stock prices were so high. Is the NASDAQ Composite Index lost 78%, and it took 16 years to gain back the losses. 16. So this idea of buy on the dip or buy and hold, it doesn't really, I'll show you the Great Recession because it doesn't work in 21st century recessions because they lose too much money, right? So if you have $1 million and you lose 78% of that, you now have $220,000. Buying and holding you wish you could do that. You're now in financial peril, right? Because now all of a sudden your credit score has plunged. You might not be able to make mortgage payments. It's going to be a financial crisis for you. So that is why, and as we get closer to retirement, we can't afford to have that kind of crisis in our life. Now, I'll also show you what happened in the Great Recession. The Dow Jones Industrial Average dropped 55%. And again, the high was in 2007, and it didn't come back to those highs until about 2015. So it's pretty important that we're all always aware of this simple pie chart plan. And when stocks are going up, everybody's very complacent. When stocks start going down, they think they lose money. But if you're really employing the plan, I'm going to encourage you to lean into emotional intelligence because it's just as important because your emotions will always have you doing pretty much until you train them, they will have you doing the opposite of what you should be doing. You'll get freaked out if we're in the war with Iran and you want to sell low. You'll get very excited that the stocks had gone so crazy at the end of 2025 that you'll want to buy high. All right, I'm going to stop it here and just see if anybody has any questions. This is why I like having the questions because you guys are seeing things that maybe not I might not see. We are very well aware of how we can all be in these social media silos, right? So I get inundated with sustainability stuff, but this particular person was hearing that Africa's the future because we have wars in the Middle East and all the colonizers are losing their African assets. And so therefore the future is in Africa. So first of all, if you wanted to invest in Africa, let's see how easy or not. My guess is it probably is easy. I'm not sure if it's easy to invest in Africa in a fund that is actually got a good credit rating, however. So I always start with iShares because at least we know that the owner of this company has a AA minus credit rating. So if we go here and we just put in Africa, we can see if we can find so here you could invest in South Africa, or they also have Saudi Arabia and Qatar. So you could, in fact, invest if you wish to. Now, let me show you a couple of other things. And this is a credit-worthy company. So it's South Africa. It's not the particular countries that were mentioned here, but South Africa is probably one of the more developed African countries. Now, also, if we go to IMF, this is the GDP growth expectations. And you can see that GDP growth is expected to be a little bit better in Africa. We've got Tanzania. I'm going to make this slightly bigger for you to see it. So Tanzania, the darker green it is, the bigger the growth, right? So it is in general looking like a very good growth story. But I will remind people that a lot of the reasons it's got good growth are for natural resources. And those natural resources are being claimed by the superpowers. It's China and the United States and Russia fighting over these natural resources. If you look at any of the conflicts that are currently going on, DRC, that sort of thing, it's got a lot to do with natural resources conflicts as well. And just as we're seeing here in the United States, war is negative for the economy, war is negative for investors. So be cautious of it. Now, another thing that a resource you can use is called the Index of Economic Freedom. So let's say, for instance, that we are interested in, here's the top countries. I'm going to view rankings for all countries. Let's say we are interested in Ghana. Mostly unfree. So the problems here for investors are outlined by this particular index of economic freedom. They update it every single year. Why is it a problem for investors? If you wanted to see, they're going to break it out into 10 different areas or 12 different areas, right? Property rights, government integrity, judicial effectiveness, tax burden, all of these things to let you know why this is still somewhat negative for investors. And you can do it for any country you might be interested in. I think that what is interesting is that if you start looking at the ones that we recommend as our value replacements, and this is based on a 12-point data analysis. So if we look at Australia as an example, it's mostly free. It's got a world ranking of number 4. And by the way, that's a lot higher than the United States, which has a ranking, I think, of around 12 the last time I looked. 22. Mostly free, but not as free as Australia. And the credit rating isn't as high. Another one that we are putting on here is Ireland. I think that is either number 1 or 2. Number 3. So a lot of the value replacements that we've got, even if you were looking at like Indonesia, is going to be ranked higher than China. So even though China has high GDP growth and all these other things, because it's ranked so lowly on the Index of Economic Freedom and other data points that I'm looking at, I'd say lean into Indonesia, not China, if you want the growth story. So again, I do outline and I don't give you all of the data points I'm looking at in terms of my hot countries blog. This is the most recent one, but I am looking at 12 different data points. And, a lot of times and I do want to also say this is a red flag. A lot of times when people say, I saw this, right? I'll say, well, where did you see it? It'll be, I came in by email or I saw it on my feed on Facebook or whatever, right? We already know, and I may have written a blog about it, or you can Google this, you can AI this, whatever you want. We already know that it's at least 10%, but I think it's a higher and an alarmingly high that Facebook and Google, YouTube, all of these channels, they know that that at least 10% of the ads on there are fraudulent, scams. So first of all, if you see something, my first reaction is this a scam? It's not, oh, isn't this exciting? I'm leaning in because I know that the percentage is very high that it could be. And then secondly, a lot of times people that are talking, they most of the time they're going to have something to sell. If they're a good marketer, if they're a good scammer, they really will be able to lock you in and then get you to buy it. And that's why they go ahead and they just change their name and they change their PayPal accounts and all of that, and they keep going back and doing it again on YouTube and on Facebook. But I would just say be very cognizant of that. Now, let's say it's not a scam, right? Good most of the time, people that are doing ads are good marketers, not good analysts. So if you're seeing something that's from somebody that's not one of the major analysts or Goldman Sachs or it's someone that you recognize, but they're just an interesting person. They might be an interesting, very good looking person with a cool looking background, right? But they might just be trying to build their brand. And they may look, when I started out 25 years ago, 20, I had a lot to learn. I was really good at what I was doing because I didn't start my beta launch until I was already 2 or 3 years deep into knowing that my analysis was working. But Most of these people are just like, look, I am out of work. I'm going to try to build a brand. I'm going to try to become an influencer. I think I can make money doing that. And so they don't have the kind of expertise that you really should be having before anybody listens to you. So I often say this, and I believe, a chapter in ABCs of Money on it. Grade your guru. Don't listen to anything until you know who's talking. You waste a lot of time watching videos by yahoos or scam artists. There's no reason to waste that kind of time. All right, I think that's enough. I'm going to go ahead and tell you guys a few things that you should be doing if you don't or haven't already done it. If you are worried about the war in Iran, and if you have lost more than 7.5%, which is what the S&P 500 has lost since January 28th, email info@nataliepace.com. And you should be getting an unbiased second opinion if you want to protect your wealth now, or at minimum, join us for our financial freedom retreat. It's online, so you don't have any travel or lodging expenses or any excuse because it's pretty easy to join us online. So there's the link. If you go to nataliepace.com, it's right there and it'll tell you all about it. You'll learn the ABCs of money that we all should have received in high school, and it will become a new foundation for your life, and it will change everything. I promise you. As it has me, but also we have plenty of testimonials. Email info@nataliepace.com, and she'll be happy to give you testimonials. So whether I see you online at our financial freedom retreat or online in a private coaching session, we can protect your wealth now. And yes, it is a good idea because 7.5% down from an all-time high is still very high. Again, info@nataliepace.com. And thank you for joining me. Okay, I hope you guys are still listening because we did have one question come in and I want to answer it. So with high oil prices and people now understanding just how volatile oil prices can be, which of course means gasoline prices are high, is that positive for green and clean energy? And the answer is absolutely. And we've seen it in a couple of different ways. The first way that we're seeing it is this blog that I showed you. I believe it was, oh, it's right here. We're seeing it in that clean energy is one of the ones that's holding up this year, right? ICLN, the S&P 500 really dropped. This is on the year, was down. This was from a few days ago. So it might be slightly different numbers, but you can see that it was up 10 still, and the S&P was down 5. Now, the other things that we've seen with that is that we're already seeing, of course, people and countries and people, individuals, everybody is like, I can't afford this, right? And all of a sudden, green energy starts looking pretty cheap by comparison. So there's a lot of states that still use a lot of natural gas to power their grid. Here in California, we actually, I went into a bank. I'm sorry, the electricity is out. My partner down in San Diego, I'm sorry, the electricity is out for the day. That is directly tied somehow to natural gas prices, for sure. And this is a very clean state. Imagine something like West Virginia, 98% powered by fossil fuels. Imagine how expensive and what's happening there because they will do surcharges on your electric bill. That's going to make the consumers ask for clean energy, but it's going to make the utilities want it too because it's too expensive for them. And then you drill down into cars. And the funny thing is that in 2004, we saw that that was when the first hybrid was launched by Toyota. And of course, everybody was afraid to drive a hybrid. People were still driving gas guzzlers. But then oil prices doubled, gasoline prices doubled, and the Prius was named the car of the year. And within a few years, General Motors, the gas guzzler producer, was, and Chrysler as well, was bankrupt, and Ford barely alive and breathing. So, yes. This is positive for electric vehicles, for clean energy in every way possible. Does it mean that you should go and just invest in the ICLN fund? No, it does not mean that. You could say, oh, maybe I'll have two hot slices of ICLN. But what you really should be saying to yourself is, hot slice of ICLN, maybe. And by the way, we did talk about this a lot when I talk about in the retreats when I talk about silver and gold, is that these are considered to be safe havens, but in the beginning of stocks going down, they go down too. But then there will be a point where they decouple and the safe havens will become in favor because everybody says, that's the only thing they're going to believe in. So, yeah, I hope that's a long way of saying yes, clean energy is in favor, but also, when stocks go way down or when economies are so much in debt as all of the developed world economies are, and the developing world is dependent upon the developed world, um, we can see that they may have to cancel clean energy projects. So it can be negative for some companies, and that's why you don't just bet the farm on clean energy. You still want to have age appropriate, proper amount safe, earning that steady income. I just want one other shout out on the safe side. If you have $1 million and you're supposed to keep that safe in, you have the other amount, a smaller amount at risk in your ETFs and your slices, $1 million earning 3.5% is $35,000 a year. That's a good amount of money for a lot of people. And there are a lot of people that have some money built up in their 401k. So you just want to make sure that you're not suffering from paper losses, you are earning income. And then, of course, as we've noted, if you are invested in the funds that we've been talking about, your 3-year performance is amazing. It's massive. It's so much higher than just the S&P 500 that, your wealth plan over the last 3 years would have been going crazy good. So this is not a day. I mean, I am very, very upset, as all of us are, that there's any kind of war going on in the world. But it doesn't gonna affect me to say, oh, I'm freaking out and I gotta sell things, because I know that my plan protects me from volatility like this. In fact, I just saw that a trade went through, and I'm guessing that it was because I had sometimes what I'll do is a limit order if I want, and I set a ridiculously low price so that if something I'm interested in hits it when I'm not in a rebalancing session, it automatically does my dollar cost averaging for me. And that's what I'm guessing would have happened right now. For those of you that are interested in sustainability and breaking free from the prison of oil and gas prices, I do encourage you to join us for the 21-day challenge at earthgratitude.org. Every day you're just going to get a little chunk of sustainability, and one action you can do. The upside is it's not just for the planet, it's for ourselves. It's for greater health, it's for weight loss, it's for saving a lot of money. It's for tastier food, all of these things that come in hand with making more informed sustainability choices. It's actually a vote for ourselves. I just want to remind you that planet has survived the extinction of many species. We're just a species here on this planet. The planet survives. The question is, does the species survive? And so that's it, and like I said, the solutions exist. So why not learn them? Because we can be the change that we need to see. And in fact, if we're alarmed at oil prices and we're still putting gasoline in our car all the time, now is the time to rethink our transportation, because most of us could save $12,000 a year or more if we could just get rid of one car. I'll leave you with that. But again, earthgratitude.org. And do register. You can see, I'll go ahead and show you how easy it is to register. Do you love our planet? Join us for the 21-day Earth Gratitude Challenge. Just click on that big banner ad and you can register right there. All right. And you can also watch our little Earth Gratitude video. Was made by Alvin Tam, and Sia donated one of her songs to us, which we're really grateful for.